Number one, what is currently happening in the markets is that the biggest debt bubble in history is in the process of popping. And the central banks are being integral in popping that massive bubble. While a rising gold price is an indication of a failing currency. And once you really understand that this stuff is going away, then you go to this stuff. But if you go to gold, it's outside of the system.
Lynette Zang, the chief market analyst at ITM Trading, recently appeared on Liberty and Finance, where she expressed her views on the current state of the markets and gold. Lynette believes that the world is facing the largest debt bubble in history. She highlights that central banks have played a crucial role in creating this bubble by printing too much money and keeping interest rates too low. This has led to inflation and asset bubbles, which are now starting to burst. Lynette points to the rising price of gold as an indicator of a failing currency. Gold is traditionally considered a hedge against inflation, so its increasing value suggests that people are losing faith in fiat currencies. She emphasizes that gold is outside of the existing financial system and holds no geopolitical or counterparty risks. This makes it a valuable asset in times of economic turmoil, such as the current crisis. Lynette also highlights that the debt ceiling issue in 2011, which resulted in a credit rating downgrade for the U.S., has led to a more unstable relationship between global central banks and the country. She expresses her concern about the potential risk of the U.S. being unable to fulfill its debt obligations, which could have a significant impact on the validity of Treasury bonds. Treasury bonds play a crucial role in the global financial system, so this would be a major event. We will now bring you clips from Lynette Zang's interview with Liberty and Finance. But wait, there's more. To stay updated with all our future uploads, make sure to hit that subscribe button and turn on post notifications. Thank you, and enjoy the video.
You know, what is gold's function? Gold is savings. That's what it is. It's protection. What's Turkey going through right now? You know, they need a lot of protection. So gold in Turkey, they're not selling it because they feel, they don't need it anymore. They're selling it so that they have access to the things that they need because nobody will take the Turkish currency. Next big crisis, which, I mean, who knows when we're going to see that. But the reality is this is the end of the current system's life cycle. And it actually died in 2008.
That's
and
right.
They just pumped a whole bunch of, garbage into the system to make it look like it's still alive and still viable when it's not. I mean, did you look at Zimbabwe, right?
Yep.
Zimbabwe's stock market is up 600% because people are trying to save themselves for the depreciation in the currency because the public gets it. And they've been dealing with it for a very long time. But is the stock market really going to save anybody? No, because the only thing you can convert your stocks into is this garbage that they're devaluing. And that's the only choice that they have. And officially, we have 3 cents left. And if you go on the Fed, you just see that continue to decline. So that's official. When we get to zero, is that because the public has lost confidence in this currency, in this con game, is absolutely over? Think back to when we played with the debt ceiling in 2011, and then we got a credit downgrade, which if you have lower credit, then that means that you have to pay more interest on a global level. But the difference between 2011 and 2023 is the level that the global central banks and the global countries have with the U.S. and how close we came to a debt default, even with some in Congress saying, well, maybe we should have a debt default. So, it's really precarious because Treasury bonds are the foundation of the global financial system. And we're playing with the validity of those Treasury bonds and sucking the liquidity, the ability to easily buy and sell them without big price dislocations. We're now about to suck even more liquidity out of the Treasury bond market. I don't think this is over yet. People don't really know this, but somebody has to buy those treasuries. So you have the Federal Reserve that has been buying those treasuries now running off their balance sheet. So not only are they presumably, at least at this point, not buying any more treasuries, but they're actually selling treasuries into an already saturated market. So then the question is, well, who's going to buy all of these treasuries? And quite honestly, historically, and my bet would be right now, institutional investors that invests the public's money in pensions, in 401ks, in other retirement and other mutual funds, that they're going to have to be the ones to absorb it if we don't have the Federal Reserve absorbing it. And they've been absorbing the excess since the end of 2002.
During an interview, Lynette discussed the potential challenges faced by banks due to rising interest rates and lower market valuation of bonds held by these banks. She emphasized that this issue affects both community banks and larger institutions like JP Morgan, as they have accumulated treasuries at near zero interest rates since 2008. Lynette also highlights the concept of non-recourse loans, which means that the banks cannot seize other assets to repay the debts. She points out that the mortgages and other debt instruments obtained during the low interest rate period have lost value in the current higher rate environment. This applies not only to residential properties, but also to commercial real estate, which has been hit harder. Let's get back to the interview.
I think it's an attempt to prepare us, because the problem with those other banks, I mean, there were a lot of problems, but a key problem is the raising interest rates and the lower market valuation on the bonds that are held by all of these banks. And I don't care whether you're a community bank or you're a JP Morgan. This is going to be true for everybody, because they've been loading up on treasuries at basically zero interest rates since 2008. Okay, well, you can put them on your books. There's all sorts of funny accounting tools that can be used to hide the problem or make it seem like it's not that big. But I think Janet Yellen realizes that they can't hide this forever, so she wants to maybe be on record as saying, oh, okay, there are going to be more banks that fail. But I told you there were going to be more banks that fail. If they have non-recourse loans, which apparently these two loans were non-recourse, so basically what that means is they can't go in and attach other assets to pay these debts. That means that those banks, and by the way, all of those mortgages, all of our mortgages that were put in that lower interest rate environment have also lost value, right? Any debt instruments that were put in the lower rate environment and we're now in a higher rate environment has all lost value. So whether it's any kind of real estate, quite honestly, but in the commercial sector, yeah, that's been hit a lot harder. And we're going to see a ripple effect as these corporations give up the real estate to the banks. Who are they going to sell them to? And at what price?
As interest rates continue to rise, it is likely that the stock market will experience some volatility. This is because higher interest rates make it more expensive for companies to borrow money, leading to lower earnings and stock prices. However, the stock market is still expected to outperform other asset classes over the long term. Gold is also likely to perform well in a rising interest rate environment. This is because gold is seen as a safe haven asset, and its price tends to rise when investors are worried about the economy. However, it is important to note that gold is a volatile asset, and its price can fluctuate significantly. Overall, it is likely that the stock market and gold will both perform well in a rising interest rate environment. However, investors should be prepared for some volatility in the stock market. What are your thoughts on the future of the stock market and gold? Please share your comments and observations in the comments section below. Additionally, if you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.